Hi everyone, let's go over my bullish and bearish Elliott Wave scenarios on Bitcoin, starting with the low time frame bearish scenario where we're looking for a finished wave 1 or A, finished 2 or B, and now a wave C or a wave 3 to the downside. If, however, we are looking for a wave 3, I prefer to see big bearish CVD divergences between the origin of wave 1 and the end of a wave 2 to show that there is absorption of market longs going on and therefore absorption by bigger limit shorts to push price to the downside. But at the moment, that is not what we see. If we go to the 1 hour CVD chart, you can see that we have lower highs on price, but also lower highs on the CVD, and not lower highs on price, higher high on the CVD. So the fact that over here CVD is moving to the downside as price is ranging is increasing the probabilities that we still have more upside to go. And if we are looking for a wave A, B, and then a wave C, that is exactly what we are looking for, as then after a wave C, we're looking for price to move towards the upside. The most common target area for your wave C is between the 1 and the 1.236, which is between 38.9k and 37.8k, which is in confluence with this additional support area, the golden box here between 38.6 and 39k. If price would now move towards the upside and hit this level over here, the invalidation at 44.7k, then this scenario becomes invalid. Now, if we look at this structure over here for 2 or B, I have two scenarios, and both of these scenarios are not that great. The first one, which is the higher probability of the two, I suppose, is a finished WXY, because of course in this particular scenario, wave 2 or B has to then end over here, and we're already looking for a move to the downside. So this is your corrective structure. So if we do a little bit of research into that corrective structure, there is two possibilities to finish a potential move here. The first one is a WXY. W is a zigzag, X is a complex structure, and then you have wave Y in a flat. Now, because wave W here is a zigzag, and we are talking here about a sideways double combo WXY, wave Y cannot be a zigzag. So wave Y has to be a flat or a triangle. But at the moment, as you can clearly see after this X, there's clearly no triangle going on over here, unless you would move X over here and potentially you're looking for triangle yet to come. But this looks impulsive at the moment and not a three-wave structure and an ABC. And if we look for a flat, then we're looking for an A, B, and a wave C over here, where your wave B did dip below the 1.618, which is quite low for a wave B. The 1.618 is already a less common target for a wave B, and then an A, B, C. So dipping below here and closing candles below lowers the probabilities for this scenario. And if we're looking at this being a wave C, then at least it did go above the high of A and then an ABC, which is what you want to see. But it actually did not hit the 0.618. And the 0.618 all the way to the 1.618 that you see over here are targets for wave Y, which is the blue one. The fibs that you see over here are taken from the low to the high of W to the low of wave X, and the wave Y usually ends between at least the 0.618 and the 1.236. Most commonly between the 1 and the 1.236, a little bit less common, but still common, is the 0.618, and less common is the 1.618. But the 0.618, as you can see, has not been hit, which is not something that you like to see for a wave Y, which lowers the probabilities for this scenario. Now, the second scenario here is that we are looking for a flat structure and then an A, B, and a wave C. Now, on my chart, wave B did not retrace to the 0.9 Fibonacci taken from the low to the high of A, which is a minimum requirement for a wave B of a flat. The fact that it is not hit on my chart is something that I don't like to see. It lowers the probabilities for me for this scenario. However, on some charts, wave B did hit the 0.9, so it is something that I for now keep on my chart. Nonetheless, not something I like to see. And if we're looking for this move up to be a wave C and then an ABC flat, then wave C did not take the high of wave A. It missed it by just a few dollars. Now again, on at least one chart I know, based on the comment section on YouTube, this high got taken, but on other charts, this high did not get taken, which also increases probabilities that price still is going to move to the upside to take this high, just like some other charts have done. But also, if this would be the high of C, then we're talking about a running flat because C didn't take the high of wave A, which is also the most rare flat pattern, as the most common one would be an expanding flat, A, B, C. Then a little less common is a regular flat with then an A, B, C like this, and then only then comes the running flat. So not great probabilities. If we then look at the low time frame bullish scenario, then we are looking for price to still move to the upside first to take the double top here, and then we're looking for either a WXY structure or a wave A, B, C, and then a flat structure. That depends on how high this price action goes. If price moves to the upside, we do have some resistance above price here, which is the blue box between 43.5 and 44k, and if price can move above and close above this box and build some more bullish CVD divergences, we can be looking for the yellow box here, the golden box, which is sitting between 45.2k and 46k for then a potential expanding flat and then an A, B, and eventually a wave C to the downside. Now I have three scenarios here for this particular case. The first one is again a flat structure where we then have an A, B, and then a wave C to the upside. However, also in this case, wave B of course did not hit the 0.9 Fibonacci taken from the low to the high of wave A, which is not something that I like to see. In the second scenario, we are then looking for a double zigzag. We have a zigzag over here in wave W, complex structure in X, and then we're looking for another zigzag to the upside in wave Y and then a 535. But what you don't really like to see for a wave X is candles closing below the 0.7 Fibonacci taken from the low to the high of W. So it does lower the probabilities a bit, but it does not invalidate the scenario, which is important. It's more like a guideline. It's not a rule. A rule would be for price to take this low. If price would have come down further and take this low, then a double zigzag was invalidated. But at the moment, as long as this low holds over here, we could be looking for a double zigzag to the upside. And then the third scenario would be that X or B is not yet finished. So we do have a finished A or W. We still continue ranging here sideways in an X or B before then a move to the upside in a wave Y or a wave C. If we look at the range, then we just rejected at the value area high of this range, where we also have the double top, high number 1, high number 2. Currently, right on top of the point of control, the value area low is sitting at 41k. The fact that price over here did bounce on the 886 taken from the low to the high here does increase probabilities that any move to the upside is a corrective structure, which increases probabilities that later we can see price moving to the downside to still take these lows. If we look at the CVD divergences and also the 886 here locally, there was a clear sign that we were going to be looking for lower prices on the chart. Now, the previous update that I made was when price was somewhere over here. When price continued ranging, it hit the local 886, which is taken from the low to the high. And the moment the 886 is hit, as we often say on the channel, the probabilities increase for price to first of all revisit the golden pocket, as it often likes to do, but then the probabilities increase to move to lower prices, because after an 886 is touched, either price likes to reject at the golden pocket and immediately continue down, or we get a bit of a C or a wave Y to the upside. That's the higher probability that any move after the 886 is a wave C or Y, and then we're gonna visit the lows anyway later, right? All probabilities, but the probabilities played out very, very nicely. 886 touch, golden pocket touch, and then rejecting to the downside. Bit more bearish CVD divergences here as well, as price was ranging here shortly for then a move towards the downside. And if we look at the CVD divergences more locally, then we do see some bullish CVD divergences still, where if we do this, you can see we have a higher low on the chart here, higher low in price, but over here we have on yellow, I have to zoom in maybe a little bit more here, on yellow with this low, we have actually a higher low in price, but we have a lower low on the CVD over here. So those are bullish CVD divergences, increasing the probability still for price to move to the upside first. If we then look at the probabilities of the different scenarios, then on the low time frame, I write here neutral, we're in the middle of a range. If the double top gets taken first, meaning if price is going to take 43.5k first and potentially move higher, of course, if we can break the blue box. I'll be looking for the golden box. But if the highs over here get taken first, then I'm still looking for price to move to the downside to take the lows over here at a later stage because of the 886 touch here as well and the corrective price action we have, the nature at the moment. If the lows over here would get taken first, then I'm still looking for a move towards the upside to then take the highs. So basically continue ranging. Now if you look at the micro over here, right, then for me the probabilities here are still higher at the moment for price to move to the upside first. So as the micro bear scenarios don't carry great probabilities, which is here the WXY, where wave Y did not end between the 0.618 and the 1.236, or here an ABC, where then we're talking about a running flat, but also wave B not hitting the 0.9. I prefer to see the highs taken first and then take it from there. Now, side note here, so far we have not seen any big bearish CVD divergences, which means we have not yet seen any big market long absorption with big limit short orders, which increases probabilities. We're still going to see higher prices on the medium time frame as well. And also continuously, we are seeing bullish CVDs building. We have bullish CVDs if we zoom out over here on the AGGR chart, bullish CVDs over here, which have not yet played out because then we're looking for this high, and also a bit of bullish CVDs over here. So that is very interesting, of course. I hope this video was helpful or valuable to you. Please check out the most recent educational video I've made about the best trading indicator you can use. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.